Today, we're diving into a really fascinating real-world case study. We're going to break down exactly how one couple in Singapore, one of the most expensive cities on the planet, is planning to hit financial freedom and retire on a nest egg of 4 million Singapore dollars.
So that's the big question, right? Is 4 million bucks actually enough to retire comfortably in a place with such a crazy high cost of living? In this explainer, we're going to walk you through their exact numbers, their entire strategy, and the one single decision that makes this whole plan work.
But, this isn't just about spreadsheets and market returns. At the heart of this whole thing is a couple, age 60 and 54, and their goal is so much deeper than just money. They're not just looking to stop working. They want to start a whole new chapter focused on spiritual growth, totally free from financial anxiety. So their plan has to serve that mission. Okay, let's get into the nitty-gritty. To see if their goal is even possible, we first have to look at their balance sheet. We're going to take a look at their complete financial picture, everything they own, and what they'll need to fund this dream of theirs.
So, looking at their assets, you can see they've got a grand total of about $4.35 million. Now, a huge piece of that is their $1.5 million home, which, and this is key, is completely paid off. They also have $1.85 million in cash just sitting there ready to be invested, plus an insurance policy and their government pension fund. I mean, that is a really strong foundation to build from.
Now, what do they actually need? Well, their needs pretty much boil down to three main things: their day-to-day living expenses, a one-time chunk of cash for their child's university education, and then just bridging the gap until their government pension kicks in later. The whole idea is to cover all this with a really smart, sustainable plan.
So with all the numbers laid out, their financial advisor came up with a plan that really hinged on one single, game-changing decision, a move that would completely change their retirement math and make their spiritual goals a reality. This is the real turning point of the story.
And the plan itself is just brilliantly simple. Step 1, sell their $1.5 million private home. Step 2, move into a perfectly nice but much cheaper government-subsidized HDB flat for around $600,000. And then Step 3, the magic part, unlock $900,000 in cash that was just sitting trapped in their home equity.
Now let's put that 900 grand into perspective for a second. Before this move, remember their balance sheet? Their investable assets stood at $1.85 million, which, hey, is a great number. But just watch what happens next.
And just like that, after making the move, their investable assets shoot up to $2.75 million. That one decision to downsize adds almost $1 million to their investment engine. This is the move that makes their whole retirement plan not just possible, but incredibly safe.
Okay, so now they have this massive pile of capital. The next big question is, how do you pull an income from it that can last for decades, maybe 30, 40 years, without ever running out? This is where a little concept called the safe withdrawal rate becomes the absolute key to everything.
Let's just look at the math real quick. They need $50,000 a year to live. Once their pension starts, that's going to provide $24,000 of it. So get this, their huge $2.75 million portfolio only needs to kick out $26,000 a year to cover everything else.
And this is where you see the pure genius of this plan. That $26,000 they need to pull out, it's less than 1% of their total portfolio. To give you some context, a really common rule of thumb for a safe retirement is the 4% rule. Their plan is more than 4 times safer than that standard. This creates an absolutely incredible financial cushion, a really low-stress way to fund their life.
Just so we're all on the same page here, think of the withdrawal rate as kind of like the speed limit for your spending in retirement. It's the percentage you take out every year. And the golden rule is super simple. The lower your speed, the safer your journey, and the more likely it is that your money will not only last, but probably keep on growing.
So what's the investment engine that's going to generate this income? Well, the strategy is simple, but it's really powerful. It's built around a popular type of investment, an ETF, and in this case, one you might have heard of called QQQ. Let's take a look at the blueprint.
As you can see, the allocation is pretty straightforward. The big chunk, 70%, is invested in QQQ. Now, that's an exchange-traded fund, which is basically a single investment that holds a basket of different company stocks. QQQ tracks the 100 biggest non-financial companies on the NASDAQ. Think big tech and growth. The other 30%, that's kept in a money market fund, which is a super safe, stable place to park cash for their yearly expenses.
Now, what really puts this whole strategy into overdrive is what we're calling the Singapore advantage. First off, there's no tax on capital gains. That means all their investment growth is theirs to keep. Huge. There's also no inheritance tax.
And they can get these low-interest loans using their portfolio as collateral, which is an amazing emergency tool so they don't have to sell their investments at the wrong time.
And this brings us right back to where we started. The numbers, the strategy, the tax breaks, they're all just tools. The real goal, remember, was to get rid of that deep-seated fear of scarcity and to build a life full of purpose. And with this financial plan locked in, that dream now feels completely possible.
So is $4 million enough? Yeah, the answer is a definite yes, when it's used this intelligently. This whole plan is a powerful reminder that the goal of wealth isn't just to stack up more money, it's to design the life you actually want to live. And that leaves us with one final question for you to think about. What would true financial freedom unlock for you?